Well, g'day there, everybody. Thanks a lot for joining me as at this Thursday afternoon market recap. The turmoil persists in the US financial markets. Heck, it is continuing also to remain rather global as well. The Dow Jones Industrial Average today closing down a further 2%, roughly 460, 470 points as at the closing print for Thursday. This market recap, so to speak, as at today's date is going to be rather timely. It is, in my opinion, rather pertinent based on where we have sold off into. As at Thursday, I understand, pardon me, that I have been rather incognito over the past 1.5 weeks. That is rather strategic. Those in Pivot Point Pro have been waiting for this sell-off to come on back down and retest this rising third decelerating fan line that has, remained intact essentially since 2009. And that's what I'm going to be speaking about as at today's market close. I understand, obviously, that the sentiment out there, publicly speaking, it is exceptionally bearish, and that is, of course, expected. I've been warning about this for a number of weeks now, that as this market continues to drop, that again, the public sort of discourse, the narrative on the market is going to turn rather bearish. I understand also, as at the close on Thursday, and technically speaking yesterday on Wednesday, that the transportational average and also the Russell 2000 has technically pushed beyond 20%. So that has technically entered into bear market territory. However, what is very important to note that as at the close today, we are interacting with, again, that third decelerating fan line. So just an overview of what I'm going to walk through. I am going to begin shifting out into the weekly charts and going all the way back to 2009 to put this sell-off into perspective, and then also draw parallels back to 2014 through 2016, because what is underway at the moment, in my humble opinion, is very similar to the sort, or at least the type of consolidation that we saw during or amongst those number of years there prior to that long-term bullish trend continuing high. Now, first of all, I want you to understand that a macro bullish trend that we have been in since 2009 is assumed to be in effect until it gives us definitive signals that it has reversed. Now, we understand at the moment a lot of people are calling for, of course, that confirmation that the bullish trend has reversed, given that we have technically broke now below, of course, the 2018 calendar lows. However, that is not enough, or at least the evidence itself isn't enough, just solely based on that, to conclude that the market has reversed. There have been times in the past where we have broken to calendar lows, and it has generally happened as we have moved between, and amongst that of decelerating fan lines. Now, again, a precursor to what we spoke about over the past number of weeks, or at least in the past two pro analysis classes, we were talking about, look, when this neckline does break, i.e. this particular week it has, the sentiment itself is going to shift very negative, and also a lot of people are going to be saying that, look, we've just constituted or mapped in the first macro lower low, and again, this is going to flood the market with a bunch of sell orders, and again, that is continuing more or less into Thursday's trading session. Everything is technically bearish. I understand that, no matter how you interpret the market at the moment, other than these decelerating fan lines, I agree with you 100%. But when I zoom out into the weekly chart, this is where I want to leave you, or at least sort of map the discussion about as at the close on Thursday. This is the weekly chart of the Dow Jones Industrial Average, and I'm trying to do my best to put this sell-off, or at least what is still that of a correction, into perspective. I understand at the moment there are a million horizontal lines on my screen. Also, there are a bunch of green, orange, and red targets. These are all past historic sort of entries, targets, and stops, as we've traded, again, the continuation of this bull market higher largely. But what I want you to pay attention to at the moment is this line here, this second line here, this third line here, and then, of course, this fourth trend line that I'm drawing on my screen at the moment, really basing off, of course, March 2009. Now, first of all, I just wanted to point out, we spoke about fan lines over the weekend in much greater detail, but essentially what happens is fan lines generally occur in groups of three, and that generally applies to market indices as they continue the bull market higher. The interesting note to point out at the moment is that the Dow Jones Industrial Average is working in a series of 4 decelerating fan lines, and the reason they're called decelerating fan lines is because at the beginning of a bull market, it's generally a very fast sort of ascent or acceleration of the bullish trend, and when we technically break, say for instance, fan line number 2 will break fan line number 1 and establish fan line number 2, that will give us the framework of the larger sort of macro bullish uptrend upon which becomes support and resistance moving forward. So if I change the color of my drawing tool at the moment, you can see that we rallied on up a little bit higher into 2011. What happened? We ultimately broke fan line number 2. It may be a little bit hard to see, so I understand that, but I'm just trying to illustrate this for you. We've come on, or we sold down after we broke number 2, and that is what has established and created fan line number 3. Fan line number 3 continued for a number of years. You can see we came on back down. We kept tagging it as new support until back in the year 2015, we broke below it. And this is the very interesting sort of period, or at least the parallel to what I believe is currently underway as at the current juncture. Now, again, just to take these illustrations off my screen temporarily, just to continue with this analysis, fan line number 3 comes on up through here. We break it as support. We hold as new support. And this is still the extension of fan line number 4, this sort of purple magneted color line. This is still in effect. This is the primary macro bullish uptrend support. And until technically the Dow Jones breaks below what is currently roughly 20,000, this bull market is still intact. Now, of course, we're still technically speaking above fan line number 3. So again, just to recap, we've got 1, 2, 3. And then, of course, number 4. Number 4 is the major line in the sand, distinguishing that of a bull market and that of a bear market. But when I zoom in more so into the molecular detail, really just taking into consideration 2015 through to where we are as we're transitioning into 2019, I want you to pay very close attention to this line up here. And I know it might be a little bit hard to see, but I'm trying to illustrate or at least highlight it for you. This is fan line number 3. So again, going all the way back to 2009. Okay, that's meant to say 09. And then again, this is fan line number 4. The last time we came into contact with number 4 was back in 2014 and very early on in the period of 2016. Now, what makes this interesting is that technically, yes, we have broken what appears to be that of a hypothetical neckline. Yes, I can grant that. However, what we're doing at the moment, and as at today, is selling off back into fan line number 3. All right, so at the moment, we've been really waiting for the Dow to come on back down to roughly 23,000, even slightly below it. We may overshoot it, and really what we've been waiting on is to see whether or not we do set up some form of a major reversal, a very abrupt, quick rally to the upside. And I know this is going to shock a lot of people because, again, the majority, or at least the consensus at the moment, is exceptionally bearish. I can grant that, and I do understand that. But what would make a lot of sense is that generally when you break below the fan lines, again, this is fan line number 2 up here, this is fan line number 3 through here, it provides the structure of resistance when you come on back up and tag it, and it also acts as support as price action, right, oscillates in the larger macro bullish trend between resistance and that of support. Support being that decelerating fan line, the decelerating fan line number 3. So the first major true, all right, support test to see whether we are going to go lower. And I understand we've already moved quite a distance. The Dow Jones Industrial Average at the moment is down, I think, between 16 and 17% since that late September, early October high. So we are very firmly in corrective territory, and we remain in corrective territory, but there is still opportunity, at least for the bulls, to actually provide temporary support on this market. Who knows, it may even turn out to be macro support for this market to base and to continue higher. Again, the consensus going net short below the break line of this. They're calling this some form of a, sort of head and shoulders chart topping pattern. I tend to disagree with that. Entirely with that premise of that, and I think it's going to shock a lot of people over the next couple of months, who knows, maybe even potentially a couple of weeks, as to the potential reversal that we may set up on the Dow Jones Industrial Average, more or less from the intra-session low as at Thursday. Now, the reason I'm showing you this period right here, one, of course, we're trading through it at the moment, which is very important for us, but again, a lot of people calling out this macro lower low, which at the moment, technically speaking, on a 1-year basis is true. If I go all the way back to, however, not so much all the way back to, but all the way back to 2014, 15, 16, you'll understand that, again, this is that fan line number 2 coming up through here. I'm going to remove the line, but that's why this red extension's coming up through here. What happened was we were essentially still printing a series of higher lows and higher highs. We get to the peak as at the time at 18,250. We break the fan line, and then we come on back into fan line number 4. So pardon me, this is fan line number 3 up here. Once this happened, a lot of people were calling for, again, we've got the low, we've got a lower low, and then even a third lower low on the market until we essentially finished out of the correction territory, all right, during this entire 1.5-year period. If you want to go back and say, well, over about a 2.5-year period, price was all the way back at 1,600 very early on in the period of 2014. And here we were very early on in the period of 2016 with prices largely unchanged. It was looking pretty iffy during this period, exceptionally during the intra-session movements, where we started to see again the long continuation Morobozu dark day candlesticks on the weekly time frame, but then we started to print a series of long lower wicks. Now that's what I'm looking for as at this third decelerating fan line at the moment. Again, a lot of people who are pricing or at least selling into this decelerating fan line were ultimately burnt. So again, you have to understand the different sort of fractals of the market. Again, if you're looking at this on a molecular level on a daily time frame, which is what we do, you can gravitate around very important support areas as to where support should show up. Now, it's going to be a real test at the moment to see this market really fight its way higher. I'm not going to say it's impossible. If you go back again to this similar period, back in 2015, 2016, you can see the reversal which took place. In fact, we more or less reclaimed the highs after coming back down and tagging that decelerating fan line as short as 3 months later. So I'm not going to go out on a limb right now and say that, look, in about 3 or 4 months' time, the Dow Jones is going to be back above this all-time high. I understand a lot of people are calling for the beginning of a bear market, but even if you want to take that into consideration and just think about the yield curve as well, post the Second World War, prior to every single recession, these are just a couple of facts I'm going to throw at you. The 2 and the 10-year does technically invert, and at the moment, all right, I still don't have the closing print on the actual spread itself today, but I'm assuming it's going to be somewhere around 0.11. All right, maybe 0.10 to 0.13 at a maximum. Okay. And the yield curve itself, the difference between the spread, all right, on the 2 and the 10, it still hasn't inverted for the first time. Now, generally, if you go back and study the yield curve as well, especially on the 2 and the 10-year sort of time frame, the yield curve itself will invert once, okay, and then the spread itself will steepen. This has been a phenomenon, again, going back to or post really World War II. After you get the steepening of the first inversion, you get that secondary, right, tightening or flattening of the yield curve, which will take out ultimately what was once that first inversion, which takes us obviously below negative or at least below zero. Okay. And then once that second push happens, you get that countdown of a point on average 9.7 months until equity prices peak. So what we're looking at the moment is either a market which is really certainly an outlier in terms of what has been historically true since, again, post World War II, or we're really just running the exception at the moment, and this is going to be, some form of an outlying event whereby the actual yield curve, or at least price action in the equity markets, is forward running the actual first inversion of that 2 and 10-year spread. So this is going to play out again over a number of months. At the moment, technically speaking, in December, we may not actually invert. That's what we were looking at more so around September, October. Who knows? It's probably going to happen sometime in the first quarter of 2019. But once you get that first inversion, generally the spread again, it blows out or it steepens, and then you get the secondary push into negative territory, which takes out that first inversion low. And then during that second inversion of that yield curve, that's when again the 9.7 month lag on equity prices ultimately peaking begins to count down. So again, who knows whether or not this is some form of an exception here as we transition into 2019. But when you start looking at parallels, again, there are certainly parallels between 2014, 15, and 16. Currently what's underway and under construction on the industrial average coming back down into what has been a rather interesting correction from that second accelerating or decelerating fan line into this third decelerating fan line. And again, the big line in the sand, the true confirmation that the bull market has reversed, like we saw back in the top in 1999 or 2000, technically speaking, is when that long-term bullish trend line gets taken out. Again, from the period 2002 through to 2007, when the long-term primary bullish trend gets taken out. And currently, just to show you the exact same sort of trend line from 2009 all the way, and again, I'm just drawing that fourth decelerating fan line. Generally, again, fan lines work in groups of 3. This is a little bit of an odd bull market. It's happening in a fan line extension of 4 or a deceleration of 4. But essentially what happens is the market, when this does ultimately shift and break, the market will be moving sideways. And that is generally on a larger fractal. So pay attention to this. This is really truly going to be that confirmation of a bear market. Do I think we're in a bear market at the moment? No, personally, I do not. But I understand the arguments. Technically and fundamentally for valid reasons, at least, to suggest that, look, that the equity market, or at least the price itself, has peaked. At the same time, though, as a market technician, understanding that we have broken the neckline, or technically what people are calling a neckline, but at the same time, the parallels and the overlapping sort of themes of extensions, all right, decelerating fan lines and extensions into a future, and understanding that, again, trends are assumed to be in effect, of course, until they give us definitive signals that they have reversed. It is hard for me to simply begin selling, all right, and going net short. We did take advantage of the shorting, very much so closer to the peak, again, back in September and October on a number of markets and individual stocks. We were, again, forecasting after this bearish sort of flag pattern that equity markets and prices would go lower. That is exactly what has happened this week. And as such, and it's pretty timely as well, as we sort of transition into Christmas, all right, the markets are going to be closed a little early on Monday. They're also going to be a shortened trading week next week and also the following week too. that we are coming back down into this critical area of support where I think a lot of overreaction, especially to the Fed statements, all right, may be sort of digested a little bit further. And then again, a natural sort of unwind, or at least some form of a short squeeze that is temporarily at a minimum going to push prices higher, probably in a very sort of savage way that a lot of people are simply discounting. And again, a lot of people just jumping on the bandwagon, the negative sentiment, the sort of bearish nature that would generally come with these types of corrections in the market. But again, I would encourage you to try and disconnect yourself emotionally from the headlines which appear to be driving the market. This is looking still to be that of a correction, and this is a major support area on the Dow Jones Industrial Average. Look for reversal candlesticks down here. If you are thinking of going short at the moment, I would encourage you to think otherwise. I really genuinely think that because you may be towards the end of ultimately what has been a pretty nasty correction. Again, the Dow pushing into about 16%, I believe, is at the close. Technically speaking, also, the NASDAQ has now broken that 20% barrier, which is interesting. And this type of phenomenon, just so you know, if I can go back, I'll go into the monthly chart. This has happened in the past as well, where you see the equity markets down considerably. Oh, pardon me. Leading into a major sort of continuation higher, all right? Whether or not you go back to 2005, 2006, when the yield curve more or less inverts for the first time, if you go back to 98 as well, you get these massive sell-offs, right? That border on, pardon me, or even overshoot 20% to the downside. Then what happens is you get that final thrust higher. I still assume we're going to get something like this, and then ultimately a stagnant market. That's what I'm looking for personally, but of course I'm going to allow the technicals to to direct me in my actions. But this is, in my opinion, something that we're going through at the moment. But I do not believe that we're going to get 2 years of sort of extrapolating growth. I think we are very late cycle in this. I've been outspoken about that for quite some time. And we're just going to have to sort of follow this and watch this and see whether or not this is going to act as a major pivot reversal, which is probably going to shock a lot of people at the same time. Pay attention to that yield curve as well. I will bring you an update, obviously, as we draw closer to inversion. I think it is almost a sure thing, guaranteed, that it will invert in the first quarter of 2019. In the meantime, if you're interested, have a look into that pro analysis class where we go into individual trade setups as well. So on that note, everybody, enjoy your Thursday evening. I'll be back with you, or at least I'll see you on the weekend. And we'll see how the markets move into sort of, the seasonal sort of low volume period that we move into during the holiday period as well. All right. All the best, everyone. James signing off on behalf of Pivot Point Trading. Farewell.